What if you could capture the market's shifting trends with just one trade per year and you could achieve an outperformance of 3% versus buy and hold and a drawdown reduction of 50%. This is possible by merging the Dow Theory for the 21st century, the Blay time indicator, capitulation and thrust. We have what I consider the premium indicator, the composite, which is my pet indicator, and this is what we use in my real money portfolio, and I give my signals to all my subscribers. Let's dig deeper. First off, for you to really know the components of the composite and how they work and how they interact with each other, I give you in the description of this video below all the links to the Dow Theory for the 21st century, Blay time indicator, capitulation, composite, so you have the full reference to really see performance, how they work, and how they interact with each other. Many of you would be thinking, well, if this is Mr. Blay's pet indicator, then maybe the Dow Theory for the 21st century or the Blay time indicator are suboptimal indicators, so maybe they are not so good. No. The answer is no. Each of my indicators could be used as stand-alone trading system or time indicator. So the buy and sell signals given by the Dow Theory for the 21st century work great in terms of outperformance and drawdown reduction. The same applies to the Blay time indicator, but I will give you a very easy answer. How do you prefer to fly? Do you prefer a plane with only one engine, or you prefer to fly with a plane that has two engines? I can tell you that the plane with the two engines will give you a smoother ride and furthermore more safety. In case one motor has a hiccup, then you have the other one and you can do an emergency landing. If you only have one motor, one engine in your plane, then you're trusting all your fortunes to the success of this engine. So the composite, by integrating the two main time indicators, takes the best of each one, and the result is even better in terms of risk-adjusted performance than each of its components. As you can see in this table, the performance for the Dow Theory for 21st century Blay time indicator and the composite itself are really very similar, both in terms of outperformance and drawdown reduction. But the nice thing is not only getting obsessed with performance and even drawdown reduction, but also to acknowledge that there are spells when the Dow Theory for the 21st century will outperform the Blay time indicator, and other spells when it will be the Blay time indicator the winner. When I say that one of my indicators outperforms the other, I do not mean that the other is lack of performance. So when I say outperforms, mean that one makes a lot and the other one makes a little bit less than a lot, but also makes a lot. So I'm not talking about lack of performance. But of course, there are periods where the Dow Theory performs better than the BTI and vice versa. Look at this table. In this table, I plotted the performance of the Dow Theory for the 21st century and that of the Blay time indicator over 22 years. You can see that there are periods when the Blay time indicator performs better and periods when the Dow Theory performs better. So if you only had one time indicator, you will feel frustrated when the occasional spell of reciprocal underperformance occurs. But what if you have the composite? Then you are beyond all these issues. So you have a very robust and solid indicator that is going to be aligned with the stock market more time. I always insist in the psychological aspect of trading. You can have the best indicator in the world, you can have the holy grail of investing, but the weakest part is our own psychology. So if we throw in the towel at the worst possible moment, we will lose, no matter how good your trading system is. And this is why I place lots of emphasis in getting trading systems that underperform the less possible amount of time, and in order not to test your patience. Because I know we are all very mature, very brave when it comes to back testing. But in real life, we tend to panic at the worst possible moment. So by having the composite, which tends to have the shortest spells of underperformance versus the stock indexes, we ensure that we will not panic, or at least we reduce the odds of our panicking at the worst possible moment. Going back to the performance table of the composite, we may observe that we achieve a significant outperformance, 3% when we use the Dow Industrials as our reference index, 6% as I show in this chart when we use the Nasdaq 100, but the important thing is that we get this benefit with a drawdown reduction of around 50% when we trade the Dow Industrials, or even more than 50% when we use the Nasdaq 100. This is a huge drawdown reduction. And normally we get focused on outperformance, but the best offense is good defense. So first off, we have to cut drawdowns. And this is what the composite does in a very efficient way. I want also to stress that the composite is not over trading. So the average trade lasts around 1 year. So this is really exceptional. I don't want to bother you now in this video, but there are ways to measure the outperformance or the risk-adjusted outperformance versus the amount of trading. And I think that the best relationship between the amount of work and the results you obtain are with a composite. Of course, if you have ample time, you can do even better. But if you want to squeeze the maximum outperformance with the least amount of time, I think that it's close to impossible to get more performance, the performance we get with a composite. Because this is no secret, there are channel breakout systems and other ways to trend the stock market, and if you are lucky and hit the right one, you will perhaps make a little bit more performance. But of course, then you are doing much more trading. Then you will get 6, 7, 8 signals per year. So the best relationship between number of signals and performance and drawdown reduction is a composite, and I'm really very convinced about this truth. The buy and sell signals given by the composite, as I told you, can be applied to the SPY or to the QQQ, to the Nasdaq 100 ETF, which yields excellent results in terms of drawdown reduction and outperformance, but also it can be applied to a basket of stocks, because of course, if you have time and you really want to go for big outperformance, you have to end up trading stocks. There is no way around that. But of course, the composite also lends itself well to being applied to a basket of stocks. In a nutshell, the composite is the easy and most convenient way to outperform the market, to achieve significant drawdown reduction, and live your own life with only, on average, 1 trade per year. But of course, most of you will be thinking, yes, but I want to push the envelope and I want to go for a performance of 15% per year versus buy and hold. Then you need stocks. You need to do stock picking. And this is what I will explain to you in the next episode of this market timing and stock picking course. See you soon.